When it comes to the high-stakes world of investing, most beginners eventually find themselves paralyzed by a single high-pressure question. Should I invest steadily over time? Or should I wait for the perfect opportunity when the market inevitably drops? It is the classic financial standoff between dollar-cost averaging, DCA, and buying the dip. This debate isn't just about math. It is about human psychology, the fear of missing out, and the agonizing dread of buying at the very top. To master your wealth, you must understand the mechanics of these two strategies, the cold, hard data behind them, and the mental traps that cause even the smartest investors to fail. Let's start with the cornerstone of disciplined wealth building, dollar-cost averaging, or DCA. This strategy is deceptively simple. You invest a fixed amount of money at regular intervals, weekly, monthly, or quarterly, regardless of whether the market is screaming toward new highs or crashing into a deep red abyss. Imagine investing $500 on the first of every month into a broad index fund. Some months, that $500 buys you fewer shares because prices are high. Other months, when the market is in a slump, that same $500 buys you significantly more. This is where the magic of averaging happens. You aren't trying to outsmart the market. You are letting the market's natural volatility work in your favor. The greatest strength of DCA is that it removes the most dangerous element from the investing equation: your emotions. By automating your contributions, you eliminate the need to check the news, analyze charts, or listen to experts predicting the next Great Depression. It is a strategy built on the philosophy that time in the market is infinitely more valuable than timing the market. For the average person earning a steady paycheck, DCA is the ultimate tool for building long-term wealth without the stress of constant monitoring. On the other side of the ring is the more seductive strategy: buying the dip. This approach appeals to our natural desire for a bargain. The logic is straightforward. Why buy a stock at full price today when you can wait for a 5%, 10%, or 20% sale? It sounds like a sophisticated way to maximize returns. However, buying the dip is much harder in practice than it is in theory. First, you have to define what a dip actually is. Is a 5% drop a signal to buy, or is it just the beginning of a 40% crash? If you buy too early, you run out of cash before the real bottom hits. If you wait too long, the market might rebound and leave you standing on the sidelines with a pile of cash that is losing value to inflation. The fundamental flaw in waiting for a dip is that while you are waiting, the market is often trending upward. If the market rises by 15% while you are waiting for a 10% drop, your discounted entry price will still be higher than the price you could have had if you had just invested on day one. Even professional hedge fund managers with supercomputers struggle to time these cycles correctly. For the retail investor, trying to catch a falling knife often results in missed gains and a portfolio that underperforms the simplest index funds. To see how these theories play out in reality, let's look at a classic comparison between two fictional investors, Alex and Jordan. Both have $6,000 to invest over the course of a single year. Alex, the steady hand, chooses DCA. He invests $500 on the first day of every month, no matter what. Jordan, the opportunistic hunter, decides to wait for a dip. He keeps his $6,000 in a savings account, waiting for a market correction of at least 10%. In this hypothetical year, the market starts off shaky, dropping 8% in the first quarter. Jordan gets excited, but holds out, hoping for that 10% threshold. Suddenly, a positive inflation report hits, and the market rockets upward, trending 20% higher by the end of the year. Jordan never got his 10% dip. By December, his $6,000 is still sitting in cash, having earned almost nothing, while Alex's money has been working for him the entire time, capturing the dividends and the overall growth of the market. Jordan's hesitation didn't protect him. It cost him the most powerful force in finance: compound interest. If you need more than a fictional example, consider the landmark study conducted by Charles Schwab, which tracked 5 different investment styles over a 20-year period from 2003 to 2022. Each investor was given $2,000 at the start of every year. The results were staggering. Peter Perfect, who miraculously timed the absolute bottom of the market every single year, ended up with $138,066. Ashley Action, who simply invested her full $2,000 on the first trading day of every year without a second thought, finished with $127,506. The difference between perfect timing and lazy, immediate investing was surprisingly small. Meanwhile, Matthew Monthly, using a DCA strategy, came in third with $124,138. Even Rosie Rotten, who had the worst luck in the world and always invested at the absolute yearly peak, still ended up with $121,171. The only true loser was Larry Linger, the procrastinator who stayed in cash waiting for the right time. He finished with only $44,130. This data proves a vital point. Being in the market, even at the wrong time, is vastly superior to being out of the market. So why do so many people still try to buy the dip? The answer lies in human psychology. We are wired to avoid pain. Buying when the market is at an all-time high feels risky, even though history shows the market hits new highs quite frequently. Conversely, when the market actually crashes, our survival instinct kicks in. The dip we were waiting for finally arrives, but instead of feeling like a bargain, it feels like a disaster. The news headlines become apocalyptic, and the logical investor who planned to buy the dip suddenly finds themselves too terrified to click the buy button. This is the paradox of market timing. When it's the best time to buy, it feels like the worst time to buy. DCA solves this by making the decision for you. It forces you to buy when you are scared, and it prevents you from over-investing when you are greedy. In the current economic landscape of 2026, these lessons are more relevant than ever. With the rapid pace of technological change and shifting global dynamics, market volatility is the new normal. For most people, the smartest path is a hybrid approach. Use DCA as your primary engine. Set up an automatic transfer and forget it. This ensures that your wealth is growing every single month. If you happen to have extra cash and the market takes a significant tumble, feel free to buy the dip as a secondary bonus. But never let the search for a dip stop your consistent contributions. The goal of investing isn't to prove how smart you are by picking the bottom. It's to ensure you have enough capital to live the life you want in 10, 20, or 30 years. Ultimately, the battle between DCA and buying the dip is a battle between your ego and your future. Your ego wants the glory of a perfect trade. Your future wants the security of a large, compounded portfolio. As legendary investor Warren Buffett has often suggested, for the vast majority of people, the most effective strategy is to consistently buy a low-cost index fund and stay the course. Don't wait for the perfect moment. Make the moment perfect by starting today. The market doesn't reward those who wait. It rewards those who participate. Whether the market is up, down, or sideways, the best time to have been invested was 10 years ago. The second best time is right now. Stop overthinking the fluctuations and start building your legacy, one consistent contribution at a time.